Well, welcome to Third and Three, where we take a step from the noise and have thoughtful conversations about the issues shaping our world. I'm Chad, and I'm joined as always by my co-host Mark Belcher. Mark, say hi,
Aloha.
and Kurt Nelson. Kurt, say hi.
Hello, hi.
Great to be with you guys. All right, so the real question, well, what we're going to talk today is about market volatility and the emotions that come with that. And as we all know, particularly with whether it was the war in Ukraine or now the Iran war, it's like there has been plenty of volatility in the last year. I mean, just crazy. And so how does that impact our strategy? How does that impact the way we're looking at things? Do we actually follow the news cycles, and does that make an impact on us? So we're going to walk through that today. And I'm going to start, guys. I got a couple questions for you, and I'd love to have you comment and give me some feedback on them. So the first question is, when markets move on geopolitical headlines, are they reacting to real risk or just uncertainty?
So I think the market moves on uncertainty.
Okay.
I don't know that they care necessarily about what is particularly going on. They don't like not knowing what the future holds.
Okay. So right. So you're saying, look, it can be bad news. Bad news doesn't actually impact the markets. The markets do their worst actually when there's just a big question mark around the situation.
Yeah, I mean, bad news is going to be bad, but it's going to be certain. It's not going to be tremendously volatile up and down every day,
Right.
as we've seen lately and throughout the last couple of years. And Mark, you pointed me to some statistics that I didn't realize were true, but it seems to me, just totally anecdotally, that it has gotten much more volatile in the last 18 months than it was before then. But you pointed out some number of days that market moves more than 1%. It's not uncommon.
Actually, 2% is not uncommon, but yes, it's it's funny. You look at whether it's the tariffs or whether it's the lack of knowing how long the Iran war is going to go on. I think
It's an excursion,
ordinarily,
not a war.
yes, yeah, I'm sorry, my bad. Ordinarily, I think that if you go back and looked over time, that would have caused more disruption. I think honestly, everybody's seen the market just pop back up so often since COVID. All these young investors, because there's so many people that just pour their 401ks into ETFs, and so many young people that are just trying. They're not buying houses, so they have extra money. So I think they're basically the retail sales are strong the last 5 years, and I think FOMO is driving the market. I think people buy the dip almost every time, and nobody gets out. There is no panic. I think, and that's where we see the VIX, which is the volatility index. Like 2008, the financial crisis, it was up to 80 out of 100. It's the highest I think it's ever been. I can't speak, but and then I think COVID, it was 60 something, and the tariffs was only in the 40s, and the war, I think it got to a highest 30. I just don't think people have the same fear factor as they used to. And at some point, it'll be real, and the market will take a dip, and hopefully not anytime soon, and maybe not over this at all. But I know that staying in the market in the long run is always the best thing. We hope.
And Belch, do you think that's because people just hear a tremendous amount of bad news? Like because we're all plugged in and we have basically the news outlet on our phone, or a bunch of news outlets, that at some level we just think we've learned to just absorb bad news and just sort of go, hey, there'll be something new to worry about tomorrow. So I'm just gonna. I mean, what do you think is the cause of that optimism so quickly in thinking, hey, we're going to recover from this, so I'm not going to worry about it. I'm going to buy the dip because it'll be back up in a month from now or a week or whatever.
There are all kinds of personalities, and I think the people that buy crypto are kind of like gambler mentality. Doesn't mean they're wrong. It just means I think that they're a little bit more risky than a lot of others. I have always been the guy I would react on news, and therefore I'd watch CNBC and somebody would tell me to, buy gold, and I'd buy gold. And that's not an investing strategy, by the way. Uh, I would say that's why I don't control a lot of my money anymore. Whereas, someone like Kurt controls all his money, but he has a strategy and he stays put. He lives by that strategy. And I think, if you either have to be one or the other, or you have to have, if you want to trade, then you have to have a trading strategy. It can't be, I think this is going to happen. You actually have to have parameters built in and everything else. But I think most people just go on a whim.
So there are tools like CNN's Fear and Greed Index that actually tell us, but what do you guys think? They tell us, again, like you had mentioned, Vouch the VIX, like where people are feeling fearful and when they are feeling really greedy. Where do you think are the limits to what that shows us? Like, where are there maybe gaps, or it's actually deceiving when you look at an index like that and try to determine like if it's a buy or sell opportunity?
I think most of it is emotional. I don't think most people actually have a strategy. And I think, you have optimism, and then as it moves up the spectrum, it probably goes to, euphoria at the top. And it starts to come down. It comes down like last week or 2 days ago. There was probably a lot of anxiety. Like, holy crap, I'm down 8%, from the high. But the fear, I don't think really kicks in until quite a ways. If it would have doubled, so we were at 6,300 on the S&P. If it dipped under 6,000, you would have seen fear, and that thing could have ran, because right now we're under the 200-day moving average. But if we would have dipped under 6,000, you would have seen it topple. It could go all the way to 5,300, and that's how it works. And some of that's algorithmic, and some of it's fear based. But I think, and then you have, after that, you get the people that actually, and this was me in 2007, actually, like the sky is falling, you capitulate at the worst time you sell. It's like, holy crap. I mean, this thing is, 50%ed or whatever it was. And that's the worst problem, is to capitulate at towards the bottom, unless you can find a way to get back in a hurry. But most people actually at that point, the FOMO's gone. It's, we're going to have neighborhood watch, and I'm going to carry a gun and stop people from coming in here and stealing our crap. And that's,
Right. So, but do you think it's basically a great short-term metric, not a long-term, meaning it can tell you where people's mindset are, and for the next day, week, maybe month, you sort of know what's driving the market? But
I think you could trade on the VIX. I can't speak to the CNN one. I don't know it very well, but on the VIX, a lot of people actually look at that as a time to buy and sell. Okay. And there are strategies to that one, because that's based off of trading. It's based off of where the money's going.
Right. Sure.
But both of them are essentially metrics of emotion. Right? I mean, I don't know how CNN gets theirs, if they poll people or whatever. Right. I think the VIX is a calculation based on what the market's doing day in, day out. Okay. But again, that's emotional. So they're both indicators of short-term emotion. Yeah. And Mark, you mentioned that I have some great willpower. It's not really that. It's just I've never thought I can outsmart the market. And I use the market as a long-term investment. And so what happens this week or this year is not why I have money in the stock market. I'm looking for 5-year returns.
Right. Right.
And so if I need money next week or next month, it's out of the stock market, because I can't predict what it's going to do in the short term.
And I do that as well. I think you have to have, everybody will tell you, you have your investment account, you have your IRA, you have your Roth, you have your HSA, but you have to have, some people do 6 months, some people do 2 years, but that's basically in a money market or treasuries, and you're not worried about the market. Your money's coming out of that 4.5% yield. It's not, that money is not going to make the same return, but it's also not going to go down. And that's the safety, that you have to have. And And I do have that, but I find myself when the market goes down enough, I'll actually peel money out of there and throw it back into the investment account uh, because I feel like I should, even though that's not the strategy I've built.
And is that because
So,
you don't want to miss out on potential
yes,
earnings?
I know that market's going to pop.
Yeah.
But time in the bottom, time in the top, all that stuff, super hard.
Yeah.
Yeah.
No, it is.
So I would say that it did get way harder for me post retirement. When I was, getting a paycheck every other week, I would see the market go up and down and hardly even pay attention.
Yeah.
It didn't matter. I'm not thinking about that money in the short term.
It feels abstract almost. Yeah.
And
Well,
to me,
back then we didn't have phones, we weren't looking at stuff. I didn't watch CNBC every day.
Right.
I mean, I was at work, or commuting home, listening to sports talk.
Wait, you were at working?
Well, I mean, I retired last May, but I actually quit working in 1997.
That was like the line one of my friends had at work. He goes, "Hey, you work at Ball Aerospace. How many people work there?" And the guy looked at him and goes, "Oh, about half of them."
Oh, that's good. Okay, guys, at what point does staying informed turn into being emotionally driven by the news cycle?
I think, I want to call it the news cycle. I mean, the news cycle incorporates so many things. I mean, it used to be Walter Cronkite. Now it's, Rogan.
Right. No, but even think about like CNBC. They're looking for dramatic stories.
100%.
Anytime, like if NVIDIA has some issue, man, it's front and center because it's like, hey, should you guys get out now? Because we just heard they're having supply chain issues or they're having a hard time generating revenue and whatever the case may be.
When do you find yourself watching those channels more? When the market's calm or when it's stormy?
Oh, frothy. You watch it when it's frothy because you want it. It's like, even if they're not the right answers, it's like you feel a sense of control if you understand it. And that goes back to our original concept: is the market actually responds in the worst way when it's undecided or when it's not clear what the future is. And so our attempt maybe to go to CNBC or whatever is because we feel like, well, I want some clarity on the situation. I want to know actually what's going on. I want to understand the dynamics.
And do you ever achieve that by watching more?
No, yeah, of course not. I mean, but anyways, I wonder if watching CNBC in a situation like that actually does you more harm because they're selling fear and drama and
I mean, Mark, you're the one that watches probably the most of it. Do you ever, after getting on there for an hour, do you ever think, okay, now I'm more sure of my decision to just stay and hold?
100%. And actually, but that's just age has made that decision for me. I've proven over time, I can't time the market. I don't know more than the general market. You look at last week where people are making trades 5 minutes before Trump makes an announcement on shorting oil and buying a whole bunch of the market. It looked like insider trading. I'm not saying it had anything to do with Trump. I'm saying whoever had that knowledge has knowledge I don't have.
Yeah.
And I can't compete with that. All I can do is stay in the market. That's all I can do. Yeah. I looked at the CNN Fear and Greed Index while you guys were talking, and it weights 7 things equally. Some of those are the VIX index, Volatility Index, junk bond demand, stock price momentum, safe haven demand. So it's it's a pretty good index, I think.
Right.
Yeah.
On
real numbers.
Yeah.
Huh?
Where money's going.
Yeah. Where money's going is the indicator of like, ooh, people are freaking out and jumping out of their market assets.
Shoes?
Yeah.
Oh, yeah.
I think go back to the Oracle of Omaha. When in doubt, pull up a Warren Buffett quote. It's a voting machine in the short term and a weighing machine in the long term.
Yeah.
Yeah.
It's emotional in the short term. Yeah. Over time, stuff works. I mean, good companies are rewarded. and the market goes up and to the left,
I don't know if I would invest on it,
up and to
but
the right.
the poly markets are probably a better indicator today than most things because I think the big bets are people that actually have insider information and they're actually making bets, like, on when the war is going to start, things like that. You can't tell me that there's not big bets being made by people that have insider information. They not themselves necessarily. They might be telling somebody to do it for them, but I think if you were to follow the poly markets, you probably could invest well. I'm not going to do that, but
Right.
it's
They're fairly
unregulated.
accurate.
It's the Wild West.
Yeah.
So yeah.
All right, guys, I'm going to close it up. Volatility is not just a financial event; it's a human one, because what moves markets in the short term is often fear and greed, but what builds wealth over time is clarity, patience, and discipline. So for that, I'm going to end this episode, guys. Thanks for being a part of it, and we'll see you on the next episode.
S&P 500 up and to the right.
Aloha.
Hello and goodbye.